The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
So we're going to do it a little differently today, given what's just happened in that breaking news. Stocks for an unsafe world. So we've asked the guests to pick one each to what they would go to. Let's, Andrew, begin with you. You've got the Navigator Global investments that's listed on the ASX, so asset management company investing in a range of diversified alternative asset management companies. Why have you picked this one?
Yeah, it's a great question. Look, it's probably not one that first order thinking tells you is going to be a net beneficiary. I think the obvious plays here are clearly defence, medicine, etc. But what's really interesting is Navigator Global Investments has been completely overlooked by the market for the last, I would argue, at least a year, but certainly for the last few months, as you can see there in the stock price. Here is a company that has incredible stability, incredible growth, and incredible return on equity, all off the basis of investing in alternative asset managers. And if there is going to be one beneficiary from market volatility and market fear, it's alternative asset managers, right? Because they're offering super funds and large institutions a safe haven for their capital. So I think the market's got Navigator completely wrong. I think right at the time where we are seeing greater instability in the market is right at the time where a fund manager like Navigator, who owns stakes in a diversified portfolio of asset managers with about 120 billion US under management, so this is not small, trading on a PE of sub 4 as they are today just looks like a screaming buy. And when you can buy a company on an earnings yield of 25% that has doubled its earnings in the last 3 years and has no publicly stated information that implies it will slow down, that looks to me like a great bargain.
All right, that is Navigator Global. Mark, your pick, Vaneck Global Defence ETF, that's DFND, giving investors exposure to, a portfolio of global companies involved in military and defence research, consulting, electronic equipment as well, holds around close to 118 million, or is that billion, in total assets? You can explain, Mark.
So we picked this one. So generally our clients are more so in Lockheed, Raytheon. We've got some small exposure in a couple of European, Leonardo in Italy and Thales in France. For those that don't want the US access or don't have the US access, we've obviously, the reason we've chosen Defend is generally because it's higher in allocation to European countries. So this was, and I think I wrote in the newsletter, 2 weeks ago, recommending this same thing, this same ETF for ASX investors. Look, we have dabbled in Droneshield and things like that here in Australia, but overall, I think the ETFs is the good way to go if you're more of a passive investor, and because we're going to see those European countries having to spend more and more, and when we're talking an increase of from 2.5% to 3.5% of global GDP, countries are going to want to spend that at home if they're not, because Trump's already made it very clear he wants people to pay to be defended, and you can see that in the way he's responded with Netanyahu as well, because he's basically said, "You go for it. We're happy to not be involved," and I think he's very much trying to encourage that a little bit more independent nature, where the US doesn't have to be the centre of every conflict, because they're trying to reduce defence spending because they've got the spiralling debt, and part of that is that they've outspent by double the next 9 countries on the top 10 list of military spending, which is ridiculous really in the scheme of things. So those European-based stocks should basically, we're talking trillions of dollars, essentially a 1% increase in GDP in spending. So there's just going to be passive money coming in and contracts awarded to companies for 2, 3, 4, 5 years. They are a little bit expensive at the moment, but for days like today, they're expensive for a reason. And you're looking at something like Raytheon expecting at least 20%, 30% revenue growth for the next 5 years at least. That's on basically on current contracts. So yeah, we wanted to move away, and obviously you can't get away from being involved in the US. So we chose, obviously, a lot of the companies that are in Defend have European exposure as well. So yeah, so that's really why we've gone for that one. It's going to be a good mix of, excuse the pun, defensive nature, but also growth in and passive spending from, what are the biggest customers in the world? Governments, basically. So, and I don't. Once this has died down, and we do tend to treat the Middle East a little bit like white noise when it comes to geopolitics, these companies are still going to go up. So that's where we're very high conviction in that space at the moment, and probably will be for the coming years. And because the US has just been defending everyone for ages, that there are some stuff companies at the smaller end as well that where massive, like one contract makes the company, and then they just go on from there. So it there is a fair bit of opportunity there, and a hell of a lot of passive spending for the foreseeable future.
There we go. They are our stocks of the day.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.